Friends, thank you for being here today. I want you to think about something for a moment, not about headlines, not about stock tickers. I want you to think about a building, a very old building, one that has stood for 179 years through wars, through depressions, through the crash of 1929, through the meltdown of 2008. A building so old and so solid that you never once questioned whether the foundation was real. Now, I want you to picture a crack running straight up that wall, because that crack appeared and almost nobody noticed. On December the 2nd, 2025, Laurentian Bank, founded in 1846, older than the Canadian Confederation itself, effectively raised a white flag. They are not restructuring. They are not pivoting. They are being sold for parts. The retail banking arm is being handed to National Bank. The commercial arm is being sold to a private equity-backed lender called Fairstone. The institution that survived every financial catastrophe of the modern era looked at the mathematics of 2026 interest rates and arrived at one conclusion: we cannot survive this, and the financial press barely flinched. Now, I could end the conversation right there and the warning would be complete. But I am not going to do that, because what happened to Laurentian Bank is not a story about one bank. It is not a story about Canada. It is a story about a structural fault line that runs underneath the entire Western banking architecture, and the Laurentian collapse is the first crack you can see with the naked eye. What we are witnessing right now is the financial system beginning to tell the truth it has been hiding for 3 years. We have been told repeatedly, emphatically, by every central bank, every government spokesperson, every financial television anchor, that the soft landing was achieved, that the interest rate hikes worked, that the economy absorbed the shock and came out the other side intact. But here is the question I want you to sit with. If the soft landing is real, then why is a 179-year-old bank unable to survive it? The answer, friends, is that the soft landing was a story told to paper markets until the paper ran out. And the paper is running out. Let me give you a number. The number is $18 million. That is the provision for credit losses at Laurentian Bank for the fourth quarter of 2025 alone. A provision for credit losses, or what insiders call the PCL, is the money a bank sets aside to cover loans it does not believe it will ever get back. $18 million. That sounds manageable until you realize it represents an 80% increase from the year prior, when that same number was 10.4 million. In 12 months, the pile of bad loans that Laurentian was reserving for nearly doubled, not crept up, not adjusted slightly, nearly doubled. That is not a trend line, that is an acceleration, and the earnings miss that accompanied it was equally telling. Wall Street expected Laurentian to deliver 78 cents per share. They delivered 73, a 6.8% miss, driven not by operational inefficiency alone, but by the rising tide of commercial borrowers who are no longer paying their debts. These are businesses, real businesses, across the Canadian economy that borrowed money during the era of cheap credit and are now drowning in the era of expensive credit. This is the moment when the invisible architecture of a credit cycle becomes visible to ordinary people. And what it is showing us is not comfortable. Now I want to take you back, not to last quarter, not to last year. I want to take you back to the origin of the problem, because what is unraveling in 2025 and 2026 was built quietly and deliberately over the preceding decade. Understanding where a crack comes from is the only way to understand how deep it runs. For years, the central banking model of the developed world operated on a single axis: cheap money. The Bank of Canada, like the Federal Reserve, like the European Central Bank, held interest rates at historic lows. And in that environment, the business of banking felt almost effortless. Banks borrowed deposits cheaply. They lent that money out at a spread. The difference between what they paid depositors and what they charged borrowers, what the industry calls the net interest margin, was generous enough to cover inefficiencies, absorb modest losses, and still generate profit. But here is what I call the big secret of the entire system. That model does not actually create a healthy bank. It creates the illusion of a healthy bank. It papers over structural weaknesses with cheap capital. A bank that is running an efficiency ratio of 77%, meaning it spends 77 cents to generate every single dollar of revenue, is not a healthy institution. It is a fragile one. It can survive as long as the money is free. The moment money has a real cost, the facade begins to crumble. Think of it this way. Imagine you run a pizza shop. You make your pizzas using dough that you borrow from a supplier every morning at almost no cost. You sell the pizzas at a modest markup, and the thin margin is enough to keep the lights on. Then one day, the supplier triples the cost of the dough overnight, and the customers, pressured by their own rising costs, start ordering fewer pizzas. Your margin collapses to almost nothing, and the loans you took out to expand the shop, to build a second location, to buy new equipment, those monthly payments suddenly feel like concrete blocks around your ankles. That is precisely the situation Laurentian Bank found itself in. Their net interest margin collapsed to 1.79%. You cannot run a modern bank on razor-thin margins when your loan book is simultaneously generating an accelerating wave of defaults. The math does not work. The math, in fact, is a mathematical endgame. The CEO stood on that December earnings call and said quietly that the retail banking landscape had become too competitive and that regulatory requirements were making it difficult for smaller institutions to compete. I want you to hear what he was actually saying. He was saying that the cost of doing business in Canada has become so structurally high that only the institutions deemed too big to fail can afford it. The middle class of banking is being eliminated, not by one bad quarter, not by one mistake, by the slow arithmetic of an interest rate environment that smaller players simply cannot outlast. And I want to pause here for a moment because there is something about the timing of this collapse that deserves special attention. The stock price of Laurentian Bank actually jumped when the sale was announced. The financial press characterized it as a relief rally. Investors, they said, were pleased that a resolution had been found. But this is not a resolution. What you are watching is what I call a liquidation event. Investors are not happy because the bank is being saved. They are happy because they are getting cash now before the long-term story fully plays out. When sophisticated capital rushes to take the exit, that is not a vote of confidence in the future. That is the opposite. That is what it looks like when the smart money decides that holding paper, claims on a deteriorating institution, is a worse bet than taking the liquidity and running. This is not a success story. It is an autopsy being conducted while the patient is still breathing. And here is what I want you to carry with you through the rest of what I am about to show you. Laurentian Bank is not the story. Laurentian Bank is the warning shot. It is the sick patient in the ward who is showing you in vivid clinical detail what the plague looks like before the other patients have started showing symptoms. The question that matters, the question I will return to before this conversation is over, is not what happened to Laurentian. The question is what is already happening inside the loan books of CIBC, of Scotiabank, of the other institutions that are still presenting healthy faces to the world, while the same forces that destroyed Laurentian are working on them from the inside. Because the forces are the same. The interest rate shock is the same. The commercial real estate weakness is the same. The borrower stress is the same. The only variable that has not yet changed is the reporting date. And we are about to find out in the coming quarters exactly who has been swimming naked. Friends, let me show you what the rot actually looks like up close, because it is one thing to say that a bank failed. It is another thing entirely to understand the forensic evidence, to see the specific numbers, the specific mechanisms, the specific chain of cause and effect that turns a healthy institution into a liquidation event. Once you see it, you cannot unsee it. And once you cannot unsee it, you will start looking at every other balance sheet in the country with entirely different eyes. Let us start with what Laurentian's earnings call on December 5th, 2025 actually revealed. Revenue down 3% year over year. Net income down 23%. Those are the headline numbers. But headline numbers are the story the institution wants you to read. The story I want you to read is buried one layer deeper in the metric that professional analysts watch like a hawk when they are trying to determine whether a bank is merely struggling or genuinely dying. That metric is the efficiency ratio. Laurentian Bank's efficiency ratio hit 77.2%. Let me translate that into plain language for you. For every single dollar of revenue that Laurentian Bank generated in that quarter, they spent 77 cents just to keep the machine running. That leaves 23 cents to cover loan losses, regulatory costs, and shareholder returns. The big six Canadian banks, the Royal Banks, the TDs, the institutions we are told are the bedrock of the system, they target an efficiency ratio of around 55%. The difference between 55 and 77 is not an operational gap. It is a structural chasm. It is the difference between an institution that can absorb a shock and one that is already absorbing the shock just to stay upright. Now, here is where it gets interesting. Here is where I want you to lean in. The deterioration at Laurentian did not come from one catastrophic event. It did not come from a single bad bet or a rogue trading desk or a headline fraud. It came from three separate forces arriving at the same moment from three different directions, all hitting the same already weakened edifice simultaneously. And I call this the trifecta because when three separate fault lines snap at the same time, the result is not three separate problems. The result is a convergence that no management team, no matter how skilled, can navigate. The first force, high interest rates crushing the net interest margin. I have already walked you through the pizza shop analogy. The cost of the dough went up and the customers stopped buying. But I want you to understand the scale of what margin compression actually means inside a bank balance sheet. When the Bank of Canada raised rates aggressively, banks faced a timing mismatch. The cost of their deposits repriced upward almost immediately. Depositors demanded higher yields or moved their money elsewhere. but the income from their existing loan book repriced slowly because long-term mortgages and commercial loans at fixed rates do not simply reset overnight. The bank's expenses went up fast. The bank's income went up slow. The margin was the casualty. At 1.79%, Laurentian was operating with essentially no room for error. Any spike in defaults, any at all, and the income statement collapses. The second force, the regulatory burden eliminating smaller players. The CEO said it plainly on the call, and almost nobody repeated it loudly enough. The cost of compliance, of capital requirements, of the regulatory apparatus that exists ostensibly to protect consumers, that cost does not scale down proportionally for a small bank. A small bank pays nearly the same compliance overhead as a large bank. The Royal Bank of Canada can absorb those costs across $1 trillion balance sheet. Laurentian Bank had to absorb them across a fraction of that. What we are witnessing is a regulatory environment that was designed, or at minimum functions, to ensure that only the largest institutions survive. This is not a conspiracy. It is a stated policy direction that the industry has documented for years. The small and mid-sized banks are being structurally squeezed out of the market. And the third force, the one that I want you to pay very close attention to, because this is the one that is spreading right now across North America, is commercial real estate weakness generating a cascade of loan defaults. Laurentian's provision for credit losses did not spike because of bad mortgage decisions on residential homes. It spiked because their commercial loan book is cracking. These are businesses, office buildings, mixed-use developments, commercial properties financed in the era of zero rates, now sitting in an era of 5% rates, with vacancy rates in many Canadian cities still elevated from the structural shift toward remote work. The properties that back these loans are worth less than they were when the loans were written. The borrowers are struggling to service debts that were structured around a financial reality that no longer exists. This is what I mean when I talk about the scaffolding being built on assumptions that turned out to be false. Entire loan books were written against the assumption that interest rates would stay low, that office buildings would fill up again, that commercial real estate values would keep rising. None of those assumptions have proven true. And now the loans written against those assumptions are becoming what the industry calls impaired, which is a polite word for the money is not coming back. Laurentian's canaries sang loud, but I want to show you that they are not alone. The first canary is what I am calling the commercial rot. The impaired loans that drove Laurentian's PCL spike were not scattered randomly across their portfolio. They were concentrated in the commercial segment, businesses failing to pay their debts. Now, here is the critical question, and I want you to hold it in your mind. If Laurentian's commercial clients are failing, are CIBC's commercial clients different? Are Scotiabank's? The businesses borrowing from Laurentian are the same businesses borrowing from the Big Six. They operate in the same economy. They face the same rates. They sit in the same office buildings. The only difference in this moment is the reporting date. CIBC and Scotiabank will tell you the story of their commercial loan books in Q1 2026. Watch the PCL numbers when they report. If those numbers follow the Laurentian trend, if they accelerate the way Laurentian's accelerated, then what we are watching is not an isolated failure. It is a systemic preview. The second canary is the Fairstone pivot. And this one I want you to understand clearly, because it represents a shift in where the risk is living inside the financial system, not a reduction of the risk. Laurentian is selling its commercial lending arm to Fairstone, a private equity-backed alternative lender, what the industry calls a shadow bank. This transaction is being presented as a clean resolution. The loans leave the regulated banking system, the regulatory exposure of the acquirer is different, and on paper the risk appears to have been contained, but the loans themselves still exist. The borrowers have not changed. The commercial properties backing those loans have not improved. All that has changed is the entity holding the paper. The risk has moved from a transparent, publicly reported balance sheet into a less visible corner of the financial architecture. Shadow banking does not eliminate risk, it obscures it. It moves it to places where quarterly earnings calls do not shine a light, where regulators have less visibility, where ordinary depositors and citizens have no window into what is happening. This is precisely how the subprime mortgage crisis of 2008 unfolded. The risk did not disappear, it migrated. It moved through structured products and off-balance sheet vehicles until it was so dispersed and so obscured that no one could see the true exposure until it was too late. The difference between what happened in 2008 and what is happening now is scale and geography. But the mechanism, the transfer of deteriorating loan risk into the shadow banking sector, is identical. The third canary is the competitive collapse itself. In the span of roughly 18 months, the Canadian banking market has lost two meaningful independent players. HSBC Canada was absorbed by Royal Bank, and now Laurentian is being dismembered and distributed between National Bank and Fairstone. If you are a Canadian consumer, this matters to you directly. Every time a competitor leaves the market, the oligopoly of the Big Six tightens its grip. Fewer competitors means less pressure on fees, less pressure on mortgage rates, less pressure on the quality of service. The Canadian banking system, already one of the most concentrated in the developed world, is becoming more concentrated still. And the consumers who will pay the price for that consolidation are not the shareholders. They are the ordinary people who have a mortgage, a savings account, and a monthly fee that never seems to go down. But here is where I want to challenge you to take a larger view, because I am not describing a Canadian problem. I am describing a structural condition that exists across every developed economy that went through the same interest rate cycle, which is to say, all of them. The United States Federal Reserve ran the same experiment, zero rates, followed by the most aggressive tightening cycle in 40 years, and the American banking system has already shown its own canaries. Silicon Valley Bank, Signature Bank, First Republic. These were not isolated failures caused by individual mismanagement in isolation from the macro environment. They were the first institutions to run out of road in an environment where the road was disappearing for everyone. The larger banks absorbed the survivors, the balance sheets were transferred, and the press moved on. But the underlying stress, the commercial real estate exposure, the unrealized losses on bond portfolios bought when rates were near zero, the rising tide of borrower defaults, that stress did not move on. It is still there, it is still growing, the liquidity tide is going out, and we are about to find out who has been swimming naked. Now, I want to do something that most financial commentators will not do. I want to stop talking about the mechanics of banking for a moment and start talking about you, about your mind, about the way human psychology interacts with financial systems during the period before a crisis becomes undeniable, because this period, this exact moment we are living in right now, is the most dangerous window of all. There is a concept in behavioral psychology called normalcy bias. It describes the tendency of the human brain to assume that because something has not happened yet, it will not happen. We are wired at a neurological level to believe that tomorrow will look like yesterday. It is an evolutionary trait. The brain uses pattern recognition to conserve energy, and the pattern most heavily weighted is the one most recently experienced. If markets have been stable for 3 years, the brain assigns that stability a permanence that the evidence does not support. If your bank has been open every morning for 179 years, the brain assigns that continuity a certainty that balance sheets do not guarantee. Laurentian Bank was open every single morning for 179 years. Until it wasn't. And there is a second psychological trap that I want to name because it is arguably even more dangerous than the first. It is called the money illusion. The money illusion is what happens when people confuse the nominal value of money, the number on the statement, with its real purchasing power. You look at your savings account and it says a number. That number may be higher than it was 5 years ago, and your brain registers that as wealth. But if the cost of everything you buy has risen faster than that number grew, you have not become wealthier. You have become poorer at the grocery store while becoming richer on paper. The account balance is the illusion. The receipt at the checkout is the reality. This is not a conspiracy. It is a stated arithmetic of how monetary inflation interacts with nominal wealth. And the people who understand this dynamic, the people who do not confuse paper claims with real value, those are the people who are positioned differently when the paper starts to burn. Because here is where we arrive at the question that every single person watching this needs to answer for themselves. And I want you to take it seriously, not as a rhetorical device, but as a genuine question about the structure of your own financial life. Do you own assets, or do you own claims on assets? This is the binary choice that defines financial positioning in a period of systemic stress. An asset is a thing, land, physical gold, silver, something that exists in the world independent of any institution's promise to honor it. A claim on an asset is a piece of paper or a digital entry that represents someone else's obligation to give you something real if you ask for it. A bank deposit is a claim. A stock is a claim. An ETF is a claim on a claim. As long as the institutions honoring those claims remain solvent and liquid, the claims function perfectly. They feel exactly like assets. The problem only becomes visible when the institutions begin to crack. Laurentian Bank's depositors did not feel any different from Royal Bank's depositors until the institution announced it was being sold for parts. The question of what kind of wealth you hold is not an abstract philosophical question. It is an engineering question about the load-bearing capacity of your financial foundation during a stress event. And the stress event is not theoretical. It is already begun. Friends, let me bring this home, because everything I have shown you, the Laurentian collapse, the PCL spike, the efficiency ratio disaster, the shadow banking migration, the normalcy bias, the money illusion, all of it has been building toward a single uncomfortable, clarifying conclusion. And I want to state that conclusion with the directness it deserves, not with the clinical softness that the financial press uses to keep you comfortable while the building is coming down. The Laurentian Bank failure is not the end of the story. It is the opening paragraph. Let me show you why. When a bank the size and age of Laurentian reaches the conclusion that it cannot survive the current environment, it does not reach that conclusion in isolation. Banks of that profile, mid-sized, regional, with a century and a half of institutional history, do not simply decide one morning to liquidate themselves because of one bad quarter. The decision to break up an institution, to sell its branches to one entity and its commercial loans to another, to effectively admit that the franchise is no longer viable as a going concern. That decision is the product of months, possibly years, of internal stress that never appeared on a public earnings call. It is the product of conversations with regulators, of stress tests run quietly internally that produce numbers too uncomfortable to publish, of an honest internal accounting that said even under optimistic projections, we cannot reach the other side of this rate cycle intact. That is what a liquidation event looks like from the inside. And the fact that we are seeing it in December 2025 tells you something critically important about the timeline. The Bank of Canada's interest rate tightening cycle began in 2022. The damage it created inside vulnerable loan books did not appear immediately. It accumulated, slowly, invisibly, quarter by quarter, as borrowers who had locked in low-rate financing began to hit their renewal dates, as commercial properties backing loans began to roll over at valuations that could no longer support the original debt structure, as the net interest margin of smaller institutions compressed to the point where there was no buffer left to absorb the rising tide of defaults. This process takes time, and here is what that timing tells us. If Laurentian is breaking apart in late 2025, the institutions with slightly more capital, slightly larger deposit bases, slightly more regulatory forbearance, they are not immune. They are simply further behind on the same timeline. The same forces are working on them. The clock is just running a few quarters later. Watch the PCL numbers when the Big Six report Q1 2026. That is the number, not the headline earnings, not the dividend announcement, not the forward guidance. The provision for credit losses is the institution telling you, in the only language that cannot be entirely managed, how much of its loan book it no longer believes it will recover. When that number accelerates at CIBC, at Scotiabank, at any of the institutions that have been presenting confident faces to the public, that is the moment the Laurentian story stops being a footnote and becomes a chapter heading. And here is something that almost nobody is talking about, but which I believe is the most structurally significant element of the entire Laurentian situation. It is not the bank itself. It is where the commercial loans are going. They are going to Fairstone, a private equity-backed alternative lender, a shadow bank. I used that phrase earlier in our conversation, and I want to return to it now with more precision because the migration of deteriorating loan assets into the shadow banking sector is not a minor detail. It is the mechanism by which a localized banking stress becomes a systemic crisis. The shadow banking sector, the alternative lenders, the private credit funds, the non-bank financial intermediaries that have expanded dramatically since the 2008 crisis, precisely because stricter bank regulation pushed risk-taking into unregulated spaces. That sector now holds a staggering volume of credit exposure. Globally, shadow banking assets are estimated in the hundreds of trillions of dollars. The specific number is almost incomprehensible. What matters is the architecture. These entities are not subject to the same capital requirements as regulated banks. They are not required to maintain the same liquidity buffers. They do not have access to central bank emergency lending facilities in the same way. And critically, they do not report their loan quality metrics in quarterly public filings the way Laurentian was required to do. When Laurentian's commercial loans move to Fairstone, those loans do not become healthier. The borrowers do not change. The commercial properties backing the loans do not improve. The impairment trend that drove Laurentian's PCL spike does not reverse. What changes is the visibility. The loans go from a regulated, publicly reporting balance sheet into a private structure where the reporting is limited, the oversight is different, and the general public has essentially no window into how those assets are performing. This is not a conspiracy. It is a structural feature of the financial architecture that has been documented, warned about, and largely ignored since the aftermath of 2008. The shadow banking sector was identified by the Financial Stability Board as one of the primary vectors through which systemic risk could accumulate and suddenly destabilize the broader financial system. And in the years since that warning, the shadow banking sector has grown dramatically, not shrunk. So let me now present you with the convergence, because what we are facing is not one problem. It is three distinct forces, each serious on its own, arriving simultaneously and amplifying each other. This is the trifecta that makes the current moment different in character from ordinary economic downturns. The first force is the structural break in the mid-sized banking sector. Laurentian is not an anomaly. It is a data point. The same interest rate squeeze, the same margin compression, the same commercial real estate stress exists across every mid-sized institution in Canada and the United States that built its loan book during the era of cheap money. The question is not whether other institutions are under the same pressure. They are. The question is which ones will reach the breaking point next, and in what order. What I call the consolidation trap, where only the too big to fail giants can afford to survive, is not a Canadian phenomenon. It is a global one. And as the mid-sized banks continue to consolidate or collapse, the risk concentrates upward into institutions whose failure would be genuinely catastrophic and whose bailouts would be genuinely civilizational. The second force is the domestic liquidity crisis building inside the commercial real estate sector. The commercial loan defaults driving Laurentian's PCL spike are not unique to Laurentian's clients. They reflect a macro reality. Commercial real estate across North America is under severe stress. Office vacancy rates in major cities remain structurally elevated. The remote work revolution did not reverse. The properties that were financed on the assumption of 90% occupancy are sitting at 60 or 65%, and the math of debt service at 5% rates against 50% occupancy simply does not work. When the loans backed by those properties begin to default in volume, when the PCL numbers at larger institutions begin to reflect the true state of their commercial real estate books, the liquidity shock will not be confined to one institution's earnings call. It will spread across balance sheets simultaneously, exactly the way it spread in 2008, except that the underlying asset class will be office buildings and commercial properties rather than residential mortgages. And the third force is what I would call the sovereign confidence question. Central banks have spent 3 years telling the public that the system is sound, that the rate cycle was managed successfully, that the soft landing was achieved. Laurentian Bank's collapse is a piece of forensic evidence that challenges that narrative directly, not rhetorically, not ideologically, forensically. The data from one institution's balance sheet contradicts the official story being told about the health of the system. And when official narratives begin to lose contact with forensic reality, the consequence is not merely intellectual, it is behavioral. The moment that ordinary depositors, ordinary investors, ordinary citizens begin to question whether the institutions they have trusted with their savings are as sound as they have been told, the moment that normalcy bias gives way to rational fear, the dynamics of a financial system change in ways that are extremely difficult to reverse. A bank run does not require a rumor, it requires a question. The question is already forming. Now, I want to talk about counterparty risk because this is the concept at the center of everything I have described today, and it is the one that most directly affects your own financial decisions. Counterparty risk is the risk that the entity on the other side of your financial transaction, your bank, your broker, your ETF custodian, your pension fund, will fail to honor its obligation to you. We do not think about counterparty risk in normal times because the system functions smoothly and the risk feels theoretical. But Laurentian Bank has just demonstrated that counterparty risk is not theoretical. A 179-year-old institution just told its depositors, "You are now a National Bank customer, whether you chose that or not." The counterparty changed. The depositor had no agency in that decision. The institution made a unilateral choice driven by its own financial survival, and the depositor discovered it from a press release. This is the reality of what it means to hold claims on assets rather than assets themselves. When you hold a deposit at a bank, you are an unsecured creditor of that institution. You are in a line. The line has an order. And in a liquidation event, ordinary depositors are not at the front of that line. They are protected by deposit insurance up to a statutory limit, £85,000 in the UK, £100,000 in Canada, $250,000 in the United States. But the protection is not unlimited, and it does not cover the disruption, the inconvenience, or the psychological cost of discovering that your financial counterparty has made decisions about your money without your knowledge or consent. So, what does a rational person do with this information? I am not here to tell you to panic. Panic is the enemy of preparation. And preparation is the only thing that history has ever rewarded in the face of systemic financial stress. What I am here to tell you is that the window between the first visible crack in the edifice and the moment when the damage becomes undeniable to everyone is the window in which preparation is still possible. Once the cracks are undeniable, the exits are crowded. Once the narrative shifts from isolated event to systemic crisis, the assets that protect wealth in those environments are no longer available at reasonable prices because everyone is trying to acquire them simultaneously. The binary choice I presented earlier in this conversation is not a rhetorical device, it is an engineering question. Do you own assets or do you own claims on assets? Physical gold is not a claim. It does not require a counterparty to honor an obligation. It does not depend on an institution's solvency. It does not have a PCL number that can spike 80% in a single year. It cannot be sold for parts and transferred to a private equity-backed shadow lender without your consent. Gold has been the instrument through which wealth has been preserved across every significant monetary disruption in recorded history, not because it generates income, not because it appreciates in the way growth assets do in normal times, but because it survives the moments when paper claims fail to deliver on their promise. It is not an investment in the traditional sense. It is a step outside the line of fire. Physical silver carries the same fundamental property, with the added dimension that it functions as both a monetary metal and an industrial one, creating demand dynamics that are structurally different from gold. Land carries similar logic. It is a thing, not a claim on a thing. It cannot be printed, it cannot be diluted, it cannot become impaired in the way a bank's loan book becomes impaired. And I want to be direct with you about what I am not saying. I am not saying that the entire financial system collapses tomorrow. I am not saying that the big 6 Canadian banks will fail next quarter. What I am saying is that we are at a structural inflection point, one that a 179-year-old bank just confirmed with its own liquidation, and that the preparation appropriate to this moment is not the preparation appropriate to a period of ordinary economic management. The risk distribution has changed. The tail risks are fatter. The institutional guarantees are less reliable than they were sold to be, and the time horizon for when those risks become visible to everyone is shorter than almost any mainstream commentator is acknowledging. History favors the prepared, and the window for preparation is closing. I want to leave you with one final thought because I believe it is the most important thing I have said in this entire conversation. The most dangerous financial position is not being in the wrong asset class. The most dangerous financial position is being certain that you are in the right one. Certainty about the stability of institutions is the exact psychological condition that Laurentian Bank's depositors had before December 2nd, 2025. They had banked with a 179-year-old institution, and they had no reason to question it. The certainty itself was the vulnerability, because it prevented the question. And the question, the simple, uncomfortable, empirical question of how sound is the institution holding my money, is the most valuable question you can ask right now. Not because the answer is necessarily frightening, but because an honest answer, whatever it is worth infinitely more than the comfortable assumption of permanence in a system that Laurentian Bank has just demonstrated is anything but permanent. The fortress did not fall, but it lost a tower. And the towers that are still standing are holding the same load against the same forces on the same foundation. Watch the PCL numbers in Q1 2026. Watch them closely. Friends, thank you for being here today. Stay prepared.